welcome to the FT headquarters. Today we'll discuss the market outlook for 2020 and some of the key themes that are set to shape the investment and market landscape in the years ahead. I have with me Wouter Sturkenboom, Chief Investment Strategist for EMEA and APAC at Northern Trust Asset Management. Wouter, we are living in the longest bull market in history. This year we had very strong returns. So do you think investors are kind of justified if they sell part of their equity investments and take a profit in anticipation of a market downturn, or do you expect further upside in markets?
Yeah, we're actually in the latter camp. We do think markets should have a little bit more upside here. If we look at the backdrop in which this market rally has occurred, low inflation, low growth, but non-recessionary, that's the backdrop we think is going to continue next year. And although, of course, the gains we've had this year, which came off the sell-off in December 2018, are not going to be repeated, probably at least, in 2020, we do think that that modest continuation of upside should continue. And we're looking for sort of mid-single-digit returns on equity markets and a little bit lower, of course, on the fixed income market, given where interest rates are. Mm-hmm.
In this age of political populism, with important elections coming up in the UK first and then in the US more importantly, some industry commentators are really concerned about the potential power shift to leaders that have less friendly, business-friendly agendas, you know, like Elizabeth Warren with her wealth tax and her plans to rein in the excesses of the US businesses, and the same in the UK with Jeremy Corbyn. So do you think that generally economists do not give much importance to political elections? They see them as short-term noise. But do you think these elections may represent a threat to markets?
Well, they certainly present a challenge in terms of managing the uncertainty that comes along with these elections. However, when we think about the impact of a Corbyn win or an Elizabeth Warren win would have, we are very focused on the fact that these politicians are massively constrained in what they can actually implement. So, although their preferences are very left-wing and very anti-capital, we think that in the end, what they can actually implement is going to be much less pronounced than what they're currently coming out with. That being said, the uncertainty is still there, and especially in the US, a Warren presidency would probably be associated with a less market-friendly environment that we should take seriously and that we do think would have a marginal negative impact. However, at the same time, we are very much aware of the fact that it's too early to handicap that election. There's still a long way to go for all of these candidates, and until we know who's going to be the Democratic candidate, we're not getting too worried.
Mm-hmm. And you see that this trend to deglobalization is going to continue, fueled by the rivalry between the US and China. Do you think that investors can insulate their portfolio from geopolitical risk? Should they perhaps invest in companies that are less exposed to global trade and perhaps allocate to domestic-focused companies?
So we do think indeed that the irreconcilable differences, is what we call it, between the US and China is going to continue. Maybe in the short term we'll get a phase one trade deal, maybe the worst of the tensions goes away, but it will be a short-term deal. It won't resolve the fundamental underlying issues around technological transfers, market access. All of those things are going to stay with us. But in terms of insulating your portfolio, of course, you have to be very careful as to making sure where those exposures are and how you can manage them. The way we're currently managing them is by basically preferring US equity markets over emerging markets and staying away from emerging market debt in preference of high yield.
In the fixed income space, we've got negative yielding debt now totaling almost $12 trillion. So investors are increasingly turning to riskier instruments. What are the risks there?
Well, the risk is always that you get a sort of an imbalance in the economy and that money will flow to actors that are not actually using that money productively. And that would, of course, show up in lower productivity growth and lower economic growth in general. Even more so if that money is then sustaining companies that are so-called zombie companies, and that whole trend just accelerates itself. However, if we look currently at the imbalances in the global economy or even in regional economies, there's not a clear sign that we're anywhere near a level that should be threatening to us, that should be recessionary to us.
How much ammunition do you think central banks still have?
The monetary policy side of things we think is running out of steam. There's a little bit more in terms of policy easing that we can see, and in fact we do think at the moment, and for 2020 as well, we are in a bit of a global easing cycle in monetary policy. We expect 2 more rate cuts from both the Fed and from the Bank of England. But if you look at, for instance, the ECB, it's pretty clear that they are running out of ways to stimulate the economy. Instead, they're looking to fiscal policy to deliver the next leg of the economic growth boost that Europe clearly needs. Low interest rates, in that sense, are providing the means or the environment in which fiscal policy can be expanded. And that's exactly what we think is going to happen for 2020 and the years ahead. In fact, we think monetary policy will more and more become subservient to fiscal policy to achieve the growth targets that politicians have set themselves.
So what kind of key recommendations would you give to investors for the year ahead?
So the first key recommendation is to not take all your risk off the table. So we are still running a modestly overweight risk positioning because we think, again, low growth and low inflation, but non-recessionary, should be supportive for risk assets. Secondly, we think interest rates will stay low. A low inflationary environment will put renewed pressure on the Fed to keep cutting rates in 2020 as well. Like I said, we expect 2 more rate cuts in 2020 once that inflationary backdrop delivers the disappointment that from a Fed point of view on the inflation side that we expect. So interest rate sensitivity is a good thing to have in your portfolio. We think we are overweight duration and we have overweight positions to interest rate sensitive assets such as real estate and infrastructure. And finally, we think the trade war, even if we get a short-term deal, will continue to be a headwind to emerging market assets. So we have an emerging market underweight and a US market overweight because of that long-running trend that we expect.
Thank you very much, Wouter.
Thank you.